In the landscape of modern investing, the allure of AI technology has captivated many seeking to leverage its potential for market analysis and profitable trading. This burgeoning interest is fueled by the capability of sophisticated algorithms to parse through vast amounts of market data, recognizing trends and executing trades based on historical performance and risk assessments. However, this innovation comes with its pitfalls, as the surge in AI's application within investment strategies has equally attracted fraudsters aiming to exploit eager investors. Con artists have adeptly tapped into the enthusiasm surrounding AI investments. Deploying the very same technology to craft convincing scams, they employ a variety of tactics to dupe individuals, from using jargon and buzzwords that make dubious opportunities appear groundbreaking, to fabricating digital personas with AI to add a veneer of credibility to their schemes. Consider the instance where a cryptocurrency platform's advertisement featured a fictitious CEO brought to life through AI, promoting the company in a manner that masked its deceitful intentions. Similarly, a tale unfolded involving Randy Alexander, a retiree who was swayed into a crypto mining scam by someone impersonating a beloved country singer through social media, leading to a loss of $7,000. Additionally, the internet is rife with ads promising quick wealth through AI-driven stock market predictions, showcasing eye-catching visuals of market analytics and promising insider knowledge. These scams use advanced algorithms to create forecasts based on historical market data, but despite their sophisticated appearance, they often rely on manipulated data or misleading analysis to project inflated returns. The essence of these scams lies in their exploitation of AI to generate seemingly authoritative and lucrative investment opportunities. These predictions, while technologically advanced, often disregard the fundamental principles of investment, enticing investors with the prospect of unrealistically high returns. To navigate this minefield, investors are advised to maintain a healthy skepticism towards AI-centric investment opportunities, especially those that pressure quick action or promise outsized returns with minimal risk. It's crucial to conduct thorough research into the investment's fundamentals, the reputation of those offering it, and any associated risks. Should you encounter such opportunities, it's wise to start with minimal investment, prioritizing only what you can afford to lose without financial strain. Additionally, be cautious of investments that perform too well initially, as this could be a tactic to encourage larger investments, potentially leading to significant losses. Finally, investment schemes that operate on the premise of recruiting additional investors, akin to Ponzi or pyramid schemes, should be immediately recognized as red flags. In summary, as AI-driven investment scams become increasingly sophisticated, it is imperative for investors to approach such opportunities with vigilance and informed skepticism. By doing so, one can safeguard their financial well-being against the backdrop of technological advancements in the investment landscape.